are totally crazy. From Blitzer to Sheen to Kanye to Rom. I run with stars, Facebook is a place for your mom. What's the matter, Zuckerberg? Don't like how that sounds? I got a million customizable backgrounds. You're so totally boring. My card's on the table, hash mark. Facebook is disabled.
In the world of options, somebody once said, for every gimme, there's a gotcha.
It's all about generating positive expectancy in your portfolio.
Welcome to Option Trades. Today, I'm Tony the Bat Batiste, and I've got not one, but two trade ideas for you today.
Exploring zero DTE. We promised you we would take a look, and here we go.
Are you on a quest for trading enlightenment? Driven by an unquenchable need to find the twin flame to your chosen strategy?
Our Where's Bat Live event is the search for trading's ultimate holy grail.
Do you have what it takes to find the elusive bat as we visit 3 cities?
Join 6 Tasty Live speakers
as they present 6 unique strategies
and 6 unique clues using games and probability
to lead to the ultimate prize. Sign up for this free event today at tastylive.com/events.
I'm running Snow Leopard with this. I'm a Mac. I'm a Mac. I'm a Mac. G. Multitask MacBook handler, brother. iPhone in one hand, iPad in the other. Pop open top, Apple logo shining on the back. That's why all these player haters know that I'm the Mac. Easier to see a nun with VD than to see me ever typing on a PC. So if you got one, you can play a sad tune and play it back later in your room on your Zune. Windows made to break, and I'm here to crack it. And if I'm a Mac, that means that I'm immaculate. Style so clean like it's disinfected. Clean surfaces where white light is reflected. Plastic case, Apple Store, keep my phone protected. Check my toolbar to see if networks are detected. Use my side swipe, applications hidden in it. This is Mac world, bitch, you're just living in it. I'm a Mac. 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 Roll into the coffee shop, know I'm on a power trip. Strapped with my laptop and my own power strip. Eye outlet, about to make your cable drop. Apple logo shining off the marble on the tabletop. So if you seen me, then you seen a star. Any place I sit down, call that the Genius Bar. Looks like I'm working hard, but to really know the truth, just taking pictures of my fine self in photo booth. Interface simple, why I need a Kindle. Working on that pad keeps my fingers mad nimble. So if you think I come up short, you must be wrong. More than one reason that these ladies call me Justin Long. I'm a Mac. I'm a Mac. I'm a Mac. Yeah, Justin Long, son. You catch that? Known by the ladies as the toolbar. 10-hour battery life. Force. Quiz.
How much does it cost you guys to do simultaneous hair flips?
Years of practice. wanna be like me. Yeah.
Oh, yeah. Tasty Nation, good morning. Oh, yeah. It is Wednesday, July 17th, a little bit after 5 p.m. You know what that means. It's time for Tasty Live's evening show, The Price of Truth, a little podcast where we like to explore the incentives that govern our world. Wednesday's very simple, people. Have a great mind. Come on and share great ideas. And today is no different. We have with us, it is Wednesday, and that means we have with us the one, the only, Ilya Spivak. Ilya, how are you, my friend?
Much better after the stock sell-off today. My account is looking healthier for it.
What a day! What a day!
What a day! What a day!
Now, I was looking forward to this conversation probably since this morning they were weak. You know, it got going. This thing got going towards the open, into the open, and then it really didn't stop. Though I think most of the damage was done in the morning before noon. We've got a lot to talk about. We've got Fed squawk, my friend. We've got deteriorating global, economic data. We have, obviously, there's been a lot of shift in politics over the last, 7 days since we spoke, at least on this program. So there's a lot of ground to cover and not a lot of time to do it. So let's get going. Let's say what's up to the people. Shout out to everybody watching on tastylive.com, as well as on Tasty Trade desktop and mobile applications. If you don't have both of those things, make sure you go get them. There's only one place to participate in the conversation, my friends, and that is on YouTube. So head on over to I used to say the evil Googles. I don't know if I'm going to keep saying that. It's a little silent protest. You know what I mean? It's like a passive aggressive move I do at the beginning of every show. Head on over to Google on YouTube. Look for this face, this big inflamed head somewhere. Click and join us in the chat. I promise you, these are fine people in the chat. The salt of the earth. And tell us, were you long? Were you short? Did today help? Did today hurt? We've got a lot to talk about, so let's get right to it. Ilya, my friend, I'm gonna give you a softball of a question to open this bad boy up. What happened? I'm gonna give you the Hillary Clinton, or it's the Hillary Clinton question, or it's the what's my curly haired friend's name who ran FTX? I already forgot. SBF.
Yes, SBF.
What happened? What happened today, in your opinion, Ilya?
That, by the way, may be the greatest description of SBF ever. What's my curly friend's name?
Curly-haired friend,
yeah. So it's a very interesting thing what happened, because the range of explanations that have come out from various corners seem to be attributing this to some sort of a political thing.
Yeah.
Seem to be saying that the reason that in particular we got a hosing in semiconductors, the leaders in this market, the sort of the tech story is where the pain was most acute. And it's almost seemed like people were like, wait, what happened?
It's all tariffs.
Did somebody say
it's
something?
It's all tariffs.
Yeah, maybe.
Yeah, I don't agree with that. I think there's a lot more to it.
Maybe. Here's why I am suspect.
Okay. Well,
Chinese stocks didn't fall yesterday.
Just in case somebody's tuning in and doesn't understand the little inside conversation. I know most of the people by now, it's 5 o'clock at night or 6 o'clock or 4 o'clock, depending on where you are. Who knows what time it is?
the macro degenerate hour is what you're
It's
saying.
later. The point is, explain the headline we're talking about. What exactly is the early catalyst here, the discussion from Donald Trump and their camp?
So there was a big interview that came out from the Donald Trump camp with him. It was, I want to say it was Newsweek, but it got carried far and wide. I saw it on Bloomberg. They had a nice summary of what was said.
I think it was a Bloomberg interview, yeah.
And it was a very broad interview, lots of topics covered. But the one that really jumped out in the context of obviously people searching for what the price action means and where it might have come from is the conversation about tariffs. Now, this wasn't particularly different from what we've heard from the administration proposals before. Tariffs of 60% on imports all around. Tariffs now. A focus seemingly on China that is even more combative. And perhaps the part that really kind of grabbed everybody was the conversation about Taiwan. The idea that you
need to pay. You want protection, you got to pay up. You got to pay me, baby.
Exactly. That in a future maybe Trump administration, obviously we don't know how the election is going to go, but in a would-be second Trump administration, Taiwan would need to do more to secure U.S. support. That essentially the U.S. would be more extractive of Taiwan in the event that China were to threaten them. And that, of course, is an interesting connection to the story with what's going on with semiconductors, because Taiwan is obviously the big dominant hub for that kind of work outside of the U.S. So we have a situation ostensibly where the supply has become threatened. And of course, we've been looking at least in betting markets, the odds of a Trump presidency rising. So perhaps with some clarity on what this could mean for Taiwan and for the semiconductor space, that's why this catalyst had the impact it had. And we should say Taiwan's benchmark stock index, the TAIEX, had a bad day.
Yeah, not good. Not good to start. Well, then let me ask you,
that's the
where do your
story?
That's the backdrop, and that's the easy narrative. Why do you suspect? And that the thing about, I'm going to set, if you don't mind, I'm going to set this up. The thing about moves like this, we've been saying on this show, you've been calling it out, that when you get a market that only moves in one direction, then you've got this distribution curve that starts to look right distributed. And a right distributed marketplace doesn't, what happens is your expected value stays the same, your curve shifts to the right, but your left tail grows. So that's how your expected move stays the same. So your odds perhaps each day of climbing higher is a little bit higher. At the end of the day, if you get a down move, the down move becomes exaggerated. And that's what becomes attractive to shorts. That's what becomes attractive to bears in these worlds of hockey stick charts or grinding markets where we're just going to one side, is that left tail, the left tail risk in some of these cases, the perception of the left tail can grow. And sometimes you don't know what the catalyst is. You just know you need a catalyst. Mm-hmm. And so I guess with that setting, why are you suspicious that today is not all just about, the additional, I'm going to call it a threat of tariffs in the relationship between the U.S. and China, but more importantly, the lack of commitment we potentially have, the lack of straightforward commitment to Taiwan that could also be perceived as a threat that needs to be discounted. Why are you suspicious that that's not the only thread that needs to be pulled today?
I look at the response cross markets, and if the story were this and only this, or at the very least, if this was the dominant narrative, you might see some confirmation across assets. Now, we just mentioned Taiwan's stock market got hosed. That's one notch in the this was about not defending Taiwan in a Trump 2.0 administration sort of thing. But crude oil sharply higher today doesn't make sense, considering in the very same interview there's conversations about boosting oil production. We know that that's a familiar story. Perhaps that was already baked in. Maybe that part of it didn't need to be recalculated by markets. But nevertheless, a sharp crude oil rise.
A decent
stocks in China not falling.
Just to add to that point, there was, in fairness, a draw in crude oil inventories this morning, 4.9 million barrels. So just for fairness, that could be the equal and offsetting force acting on crude oil markets.
It could be. And of course, the idea that the Republican platform wants to expand domestic oil production, despite the fact that it's already at a record level now, they want to expand it further. So maybe that part of it was already in there. Maybe that's already been discounted. Chinese stocks didn't rally, but they also didn't fall. So there was a kind of aborted move on the major index. So if you look at FXI, if you look at ASHR, which is the kind of broader ETF that captures the entire CSI 300, China's kind of answer to the S&P 500, you get a kind of tepid day. But what you don't have is panic. You don't have these markets going, oh my God, this is going to be so much more combative. The tension's going to be greater, run for the hills. It's not there. In fact, if you look at the Hang Seng Tech Index, which is the Hong Kong-based NASDAQ adjacent type of animal, that didn't really have any kind of conviction either and didn't really go anywhere. So if this is a story about tariffs against China, and by the way, not to be outdone, the White House started to leak things out there saying they too will be tougher on China than they said earlier. And again, we know this to some extent because we know that there are no fiscal conservatives on offer. There's also not any China doves on offer in this election. Those
in
points,
rhetoric, I would agree.
In rhetoric, at least, that we are going to have a more combative posture on China from both of these candidates. We've already heard that we are going to have fiscal expansionism from both of these candidates, albeit via different channels. One via tax cuts, one via spending. That we already know. So those are not critical differences as far as markets are concerned, I would think. But you would think, though, that if the Taiwan and the semiconductor story were linked to politics, it would show up where ground zero is in Chinese stocks. That it would show up in the likes of the Aussie dollar, maybe. But even just Chinese stocks would be firmer confirmation. And they didn't do anything.
Could I give you the devil's advocate question real quick?
Of course.
The devil's advocate, you could say that the Chinese stocks are trading already with a deep discount. You had a rally at the end of last week. Sunday night, we get China GDP 4.7% versus 5.1% expected. Much weaker in an economy where you almost never expect to hear a number that does not meet the expectation of the government, and especially that big of a miss. So you get a de-risk of Chinese stocks at the beginning of the week, which are already trading at deep discount to their international counterparts as well as their home listed counterparts. So the stocks that are listed on Chinese exchanges, if you've got a dual listing here, those stocks actually in the U.S. are trading at a discount, is what I'm saying. So my point is the where we got the most pain today are probably areas that they don't have any type of discount, any type of risk discount. They've only got a perfect future ahead with 8 to 15% quarterly earnings growth. Like they only have the bright and rosy future ahead where we start getting cuts, where the economy has a soft landing. The area of the market that had the most pain today are the ones that are perhaps the most extended, and probably if you needed a discount price somewhere, it's those areas. So could the counterweight to your point be, well, these stocks are discounted, these are not?
There is another counterpoint where I'll play devil's advocate to my own argument and say
we're in Inception here. This is like a financial version of Inception.
That's right. This is like financial brain surgery right here. If you look at the simple fact that China, by its own announcement, has directed its sovereign wealth fund to buy its own stocks, this could just be official defense. The home team getting on defense and getting out there and making sure there isn't a sell-off. Possible. If there is, in fact, then most of this to be laid at the feet of the would-be tariffs, what you might expect then is a jump in inflation expectations, because tariffs are incredibly inflationary. You might then see a positive response from gold. And you know what you didn't see? You did not see dilution of Fed rate cut odds. You did not see a significant move in real rates. The TIP ETF is the TIPS index, the inflation adjusted index, and that didn't go anywhere today. Not any big convincing move here or there, and gold prices actually went the wrong way. So again, for me, it's not that the political narrative isn't something that makes some sense on some level. It's the idea that you pin all of this on this one thing and it seems suspect. Rather, I agree with your perspective that this was an excuse to take out risk in the place where it has become the most uncomfortable to have it. Where things might be extended. And when you look at the NASDAQ and when you look at the way this top has come together, it begins, drum roll, Thursday last week with CPI.
Right.
When the CPI comes out weak, and instead of the markets doing what they've been doing for 9 months, which is to say, woo, low inflation, that means rate cuts. It's a party on Wall Street, folks, and everyone's invited. Instead of doing that, they have a massive sell-off, completely outside the dynamics that they've now developed since late October, early November. Why? Because the likelihood of a September rate cut is at this point a foregone conclusion. And the markets are like the dog that caught the car.
You know, I put this together coming into the week. I think I showed it on Sunday as well. I wanted to show that this was the performance just last week, so it does not include the performance of the S&P, and this is against the S&P. I could have done this against the Qs, but this is relative performance of basically all areas of the market, specifically small cap, though, smalls and mids versus large. And this is less about last week, and it's more about just conceptualizing the difference in performance, the spread in performance between just some of like the whole catch-up trade, this rotation, that's sort of the dominating narrative over the last week or so. But the point is, yes, small caps value in IWN was up over the S&P 500 by more than 5%. Small cap core 5%. Small cap growth 4.5%, which were the leaders. Yes, they had a massive catch-up trade on a Six Sigma day last week. So the question always becomes, all right, well, if this is a rotation trade, how much is left? I mean, that's, in my mind anyway, that's the first question. How much would be theoretically left in order to normalize? Not saying it should normalize, but just trying to conceptualize this. And by the way, this spread just didn't start this year. So I'm being generous by only looking at the difference in performance for the last year. I'm being super generous because really we should go back to basically to the start of the inversion of the yield curve and start to calculate it from there. Maybe I'll go back and do it. But the point is, just for the year alone, there's a spread in performance that the S&P outperformed these areas by doing a relative strength, which basically it mimics normalizing this stuff on a day-by-day basis, putting $1 towards the S&P and shorting value, or reverse. The S&P outperformed 12.5%. So there's a decent amount. As of last week was there's a decent amount to continue to unwind and rotate out of the heavy, concentrated areas of this marketplace and put dollars to work in underutilized, underinvested areas in the marketplace. And I wonder if I could get your thoughts on, because I think you've been very outspoken about the danger and the risk in the NASDAQ and the approaching, the potential for the narrative to change, the narrative on growth and excitement in the marketplace to shift into the mid to third quarter of this year to, hey, like these numbers don't look good. And so what happens when all of that starts to occur? Is the rate cut enough to offset the potential deteriorating economic conditions that you may see at the same time? So my question is to you. You've been speaking to the NASDAQ weakness, the potential weakness. We've started to see that priced in since last Thursday. What say you, my friend, about risk deployment in areas like the Russell? And again, the question is risk rotation or risk off? Which is the more prudent strategy in the mind of Alias Bvec? Risk rotation or risk off? Do you feel like the Russell is a value trap?
I think that I think that any sort of committed risk off move begins with risk rotation. And so I think we're starting to see things, right? One would think that when the market gets a little bit weak in the knees, the first thing that happens is that capital comes out of those things that feel expensive. And then the wave continues to move. So if you get a true risk off move where basically correlations go to 1, everything starts to decline at the same time, and there is a broad-based liquidation and a move to cash, which, by the way, is not what we're seeing here. Not yet.
No, not at all. Not at all.
Right? That's not where we are. But to get there, the initial steps are to cut where the cutting is easiest. And cutting exposure where it's easiest is where markets have gone a very long way, where people might be sitting on significant positive exposure from having participated. That's kind of the easiest thing to go, okay, hold on now. Let me just lighten up here. It's been a great, great run. This now looks a little fuzzy. In my mind, though, the lingering risk is of something much greater and broader. And so I'm hesitant to be a buyer of stock generally in this environment. I still have a little bit of exposure thematically to Mexico. That took a little bit of a knockback today, but it's still something with lots and lots of a profit cushion, and it didn't clear any risk bounds. So I still have a bit of risk on exposure there. But outside of that, I would be very hesitant. And I think the better opportunity is in the bond market, where you have a kind of all-weather situation. We know that rate cuts are coming. If they're coming, then bonds should go higher. If the market ultimately likes that they're coming once again, gets over whatever this spook out is, and gets back to growth is not so bad, we have rate cuts coming, there is a technological revolution out there somewhere, la-di-da. Bonds should go higher. If there is some sort of a downturn in economic growth and stocks stumble, bonds should still go higher. And so you get a little bit of a all-weather perspective. The reason I think that the rotation story has a very significant risk of mutating into something much more kind of binary risk on, risk off, and in the off direction is because the upshot from those weak CPI numbers is that the market is afraid of the business cycle now. That essentially what Powell said last week, which was a very potent shift in tone, saying, we're not just worried about inflation now. Now we're also worried about over-tightening. We're worried about unduly hurting the labor market. All of those kind of comments speak to recession risk. And the Fed feeling like we're finally in a place where the tightening is starting to bite in earnest. Central banks don't cut rates because everything is fine. In fact, we've heard that story from Powell all year up until last week. We don't have to cut. We want to cut, but we have the luxury of time. The economy is doing fine. The unemployment rate is low. Why are we going to jump the gun and risk letting inflation out of the bag again? Let's really make sure it's good and dead. That was not what he said last week. Now we're worried about the labor market all of a sudden? Interesting, especially after 3 months of deteriorating economic data. That ISM numbers obviously were sort of the most shocking of the recent batch. But so, of course, was the CPI number that followed that, again, reinforced what Powell said and seemingly told markets, yeah, okay, the rate cuts are coming, but they're not like a future coming. They're here. We're going to give you a performative July policy meeting where we'll make it official, and then in September it's go time. And the markets have already discounted that completely. So now the question is, okay, la-di-da, rate cuts. Why, though? Because the central bank has found something intolerable enough in the economic outlook that it feels it must act. And now.
Okay. Again, devil's advocate, because, by the way, I agree with you. But for conversation purposes, I'm going to put 2 points on the board. One, before I get to the devil's advocate, our good friend Tim Buckaroo 2, great name, OPEX shenanigans, question mark, back to flat next week. I do think it does, it is a good point to point out that it is OPEX and that can drive some different types of flow behavior. So I just want to put that on the table.
Certainly an important consideration. No question.
Yes. I wonder, though, when you say, that the framing of the cut, you keep putting the framing of the cut that the Fed has seen something that it's quote unquote afraid of, that it is seeing something that it's getting worried about to the extent,
or at least something that it feels like it needs to counter.
Right. But hasn't this always been the case that we were going to get to a point where the Fed was going to, like, they were going to try to balance the risk to get to the point that the market could handle a cut, that you had sustained disinflation, and that you had to move before you got down to 2%? Because if you wait until you're at 2%, given long and variable lags, the odds that you could stop a credit contraction or you could get get into weird deflation territory, that would be a very that's like the worst, that's a checkmate scenario for the Fed, because then you have to create new stimulus, you have to drop rates to the floor to deal with whatever credit crunch you have. That's an instant checkmate scenario, which then lights inflation on fire. And they walked us through this whole charade back in 2022 or whatever, 2021, 2022. They avoided the credit crunch. They avoided the credit contraction. So now at this point, the last thing they want to do is be late to the cut. So wasn't there always going to be this point in the soft landing scenario? And I'm not saying that. I think most of me feels like this is a big ass fairy tale, but in this soft landing scenario, there was always going to be this point that if you got here before you got inflation down to 2.5%, you were going to have to start cutting rates to not be overly restrictive and again avoid the potential credit crunch by getting into a deflationary scenario. So perhaps they're not afraid, they're just on schedule or hitting their marks from their point of view, hitting their KPIs. What say you?
I mean, that doesn't, I think, at all change what the upshot is for markets. I think you're absolutely right. But the question is and was always of timing. When? When do you get into that window when the first rate cut is imminent? At what point does the Fed say, because again, it's not so much that they're afraid, it's that they've recognized that slowdown they've been waiting for and warning everyone about has either arrived or is arriving. That essentially the timing is now. And that the rubber band can't be pulled any further. That now you have to act. That the risk to growth, which everybody has been talking about for the better part of a year and a half, after all that tightening, that risk is materializing in front of us. And that the Fed is recognizing that it's materializing in a significant enough way that it feels now it has to do something about it.
Give me one reason to believe why I shouldn't buy this up like it's going out of style. This market has had almost no breathers, and that may be the reason. But again, I'm playing devil's advocate. Since May 1st, that's one reason. I knew you're going to do. Since May 1st, maybe since mid-April, this market's gone straight up. Yeah. And every small dip in the market has been bought up with reckless abandon. Give me one reason to believe that the complexity or the complexion of this market has changed and why I shouldn't be actively looking to buy up things like Nvidia, things like Apple, Amazon, the rest of the Mag 7 that make up one of every $3 in the S&P 500, something like that. Give me a few good reasons why I shouldn't do that right now, Ilya. Or why I should. Maybe you're on the other side of the boat. I don't know.
I mean, one very good reason why I am not doing that, at least in my own thinking, is I'm saying, well, what has changed? What drove the rally? What has changed now? And I think the immediacy of the rate cut is what has changed. It's no accident that this move begins in mid-April or so, the sort of latest leg of it. What we've seen from mid-April is this kind of adjustment to the Fed's higher for longer, grumpy frustration language of February, March, going into April, where the Fed goes, this inflation has stalled. I mean, they opened their May statement with saying there has been a lack of progress. For somebody that for an institution that prides itself on quote unquote Fed speak, that is being as vague and as muted in their guidance as they possibly can, so as not to spook anyone. That's very spicy language. And what we've seen then from April and through basically last week is the market saying, okay, so you don't want to cut this year like you thought you were going to in December and in March even. You're not doing 3 cuts. We're going to bake you in for 1. But what that means is that you're going to be late and that you're going to over-tighten. And so rather than us taking the rate cuts we thought you were going to do and you thought you were going to do, and just moving them from 2024 to 2025 in the baked-in outlook, we're also going to double how many of them there's going to be. So we're going to go from 80 basis points, 75 basis points, to 130, 140 in cumulative easing. That's the market saying, you all are going to miss the boat. You're late already. You're over-tightening right now. And that's April through basically last week when the Fed said, okay, you're right.
Yeah. I think Jan Hatzius he's at Goldman, I think. He wrote a blog or a paper or something like that called Why Wait? I think the general premise was why not just move in the July meeting? And regardless of whatever fairly well articulated points he made, that is not being priced into anything. No. So it's a bit of wishful thinking, I think, right now. So let me switch gears for just a second, which is we've talked, I think, about I think the Fed narrative, and we could go into Barkin's comments earlier today and things of that nature, but I do think we've got maybe 16 minutes left in the show, so I want to move on from the Fed and talk a little bit about the actual data that we've been seeing. You've been, I think rightly so, kind of waving the red flag, or at least putting the flashlight on all the red flags in terms of the deteriorating economic data. But I look at retail sales, I look at industrial production today. Like it seems like there have been, and you're not going to get everything trending in one direction.
Sure.
You're starting to get some areas of strength, some areas of weakness. GDP Now was updated. I think one of our friends, Upside Potential, pointed this out, that GDP Now was updated today from the Atlanta Fed, and it's gone from 2% where it was. It has shot up to 2.7%, which means given existing data for the quarter, and again, this was for quarter 2, that GDP and growth is still strong, man. So what do you think about some of that
model?
Right. What do you think about the economic data we had today, this week, or just in general recently? Are you seeing it as constructive or not as constructive? Like, how are you seeing more recent data?
Not constructive. I think this week we got some, obviously, retail sales numbers that were fine, basically in line with expectations. We got some, as you mentioned, industrial production numbers, a few other things that were not wholly negative, a mixed bag. You know, some gradients positive, some gradients negative, depending on how you slice and dice the outcomes. But not wholly bad by any stretch of the imagination. These numbers can be a little volatile. And so for me, the thing that really is a spooky thing is what we saw in the ISMs and then what we subsequently saw in CPI, because those are harder numbers. Of course, the jobs report is also very important to look at, because although it, at the headline payrolls number, was marginally better than expected, only marginally is how I would kind of paint that, but the prior months were revised down a lot. And more importantly, the kind of firmer survey from which the unemployment rate comes, that gave us a rise in the unemployment rate. So on the whole, the tone of the data is weaker. What's interesting is that it's not only the U.S., and this is why I think, likewise, the generalized risk-off story sounds like a risk that's growing. The data out of Europe has gotten worse. The data out of China is terrible.
Bad.
Terrible.
It's bad.
And so the data out of emerging markets in general is increasingly terrible. And so you look at this and you say, wait a second. Hold on. 50% of global GDP is the US, the Eurozone, and China.
Mm-hmm.
The other 50% of global GDP depends on demand from the Eurozone, the US, and China. Because they're basically vendors that feed into those markets. Either they are earlier in the supply chain and they feed into China, which is the middle of the supply chain where value add work is done for the most part, although they've lost a chunk of that during COVID. And end demand, of course, is where the money is. Rich world economies, the Eurozone and the US, mainly, of the big nodes. And even other major economies depend on that demand. Canada, Mexico, they depend on US demand. Central Europe, Nordic Europe, to some extent the UK, they depend on Eurozone demand. Australia, New Zealand, Southeast Asia, parts of Latin America, parts of Africa, don't really have an economy without exports to China. And so 50% is misfiring, and the other 50% needs for there not to be misfiring to have growth. Where exactly are we supposed to see growth come from then if the U.S. stumbles? Because the Europe story we know, the China story we know, they've been weak. The U.S., though, was the pocket of great optimism, resilience, and joy. Well, if this is turning finally, we have an issue.
Isn't a cut in the United States the start to alleviating problems overseas? You get what I'm saying?
It would be the beginning of something, sure, yeah.
Yeah, like everywhere else in the world, they kind of got to just hold on while we're in this higher for longer area where we're protecting Americans from inflation. But it's creating difficulties elsewhere. When we start to cut, that is going to put, the hope is it doesn't increase inflation in America and cause problems to the domestic citizens, which it may or may not. But then the likelihood is it starts to ease the economic pain abroad. Why shouldn't we be thinking that way, Ilya? That whatever is today is, but once we start pricing in a cutting cycle, and we should now start thinking 3, 6, 9, 12 months in the future what that means for global markets like China, like Europe, like Southeast Asia, any other area. Why shouldn't we be thinking that way?
We should be. The question is, where are we in this sequence? We've been betting on global rate cuts since, let's generously say, the fourth quarter of last year. So that there will be eventual rate cuts, and not just from the U.S. They've obviously already started and have been speculated about for the Bank of Canada. They've already started for the ECB. They look like they're going to start next month for the Bank of England. The Australians aren't quite on board yet, but they appear to be on a pathway to starting to think about that. To that point, the RBNZ has done an almost complete about face. They were super hawkish until this very last meeting where they said, yeah, no, we're going to have to follow into the cutting cycle. So we know this from a speculative perspective. Once the cuts arrive, the question is, against what backdrop are they arriving? And is the thing painful enough that the lag in the cuts arrival and their digestion into the economy will be sufficient to underpin things? Eventually, of course, the cuts will create some amount of underpinning for the economy. When the Fed cuts, you're lowering borrowing costs the world over. Just like when the Fed hiked, you were raising borrowing costs the world over. because you're talking about the borrowing cost of the dollar, the quintessential medium for global commercial activity. The cost of borrowing dollars is the cost of borrowing everywhere, period. Possible exception of North Korea. But outside of that, that's the cost of borrowing everywhere.
All right.
So yes, of course, when the Fed actually eases, it will eventually help to underpin everyone. The question is, how bad do things get relative to the lag of when that arrives? Because the speculative conception of this has been baked in for months already.
Got it. Totally understand. About it's to you, it's all about, I mean, in general, this is going to be about sequencing, and just because you might have the right idea doesn't mean you don't go through a multiple contraction, risk off period, correlations to one period before you get new incremental dollars going in the direction of the themes that we're talking about. Totally understood. Makes a lot of sense.
Here's the other scary thing. If the global economy contracts quickly, then global debt to GDP ratios go the wrong way. Yeah. And then you start to have a conversation about, okay, so far all of this record global debt has been sustainable at these higher interest rates. But what if you take growth away? Now what? Is it still sustainable? I don't know.
God help us. All right, my friend. Let me pivot. We've got about maybe 7 minutes-ish to talk about politics. I've been saving it lately towards the end of the show. I don't know if that's good or bad, because I feel like politics are so spicy. Perhaps they're good at audience attraction and attainment, but for the just to make sure we can focus on more substantive, more financially substantive areas, I've been taking a different path.
I like it.
The prediction market, polymarket predictions have Biden. This has been a wild ride. Immediately after the debate, his numbers for clinching the Democratic nomination went down to 41%. I think Kamala at the time, I clocked her somewhere around 44% when she initially took the lead. And since he did the ABC interview, wrote a defiantly worded letter, and then post, attempted Donald Trump assassination, his numbers have increased. It was almost like the market this morning. I tweeted about it. This morning it was trading at 74%. And I'm like, this is crazy. To me, this is like, of all of the dislocation in the market, to me, this is insane. That's too much.
Yes.
And what do you know? What is it? Peter Schiff, I think. Not Peter Schiff. What is his name?
Adam Schiff.
Adam Schiff. Thank you very much.
Yes.
Came out and
congressman from the great state of California.
Right. Came out and it's a big name. You're starting to get into heavier hitters on the Democratic side. Called for President Biden to drop out of the presidential race. So because he's such a high-ranking Democrat, boom, it immediately takes 24%. And now we're likely going to have this conversation. So it was like this twilight period where the conversation around Biden was kind of left alone. And now it seems like that's still a contentious issue. It was not settled, and we're back into this 50-50 world. What do you think happens from here, man? Do you think Biden clenches, or do you think this is a slow, inevitable wait for him to realize that this is either going to be done the easy way with him stepping down, or the hard way with the nasty politics and leaks and stuff like that can play itself out here? What do you think? You think it's the easy way or hard way ask towards Biden, and he's choosing the hard way, or do you think there's a possibility that Biden is able to corral the Democrats around him heading into the convention?
So a couple things. I think I'm not sure that it matters terribly who the Democrats have on the ticket, as long as it's somebody reasonably palatable and not somebody way outside the party's own norms. Because I think what we have seen with Biden's initial election, out of a sea of more left-wing options, and even more centrist options that were not as tested, not as steady, not as long of a career behind them. From that election onward, what we see is the Democratic electorate tends to vote relatively center of center. And the people that you hear kind of covered in media and yelling in protests and showing up on X, et cetera, that hasn't really been the voice that's been the voting trajectory. So we saw pushback to things like defunding police and pushback on a whole host of COVID-related things. The red wave never materialized in the midterms, as some were speculating. And so I think the Democratic voter is relatively center of its position now. And so as long as you put a candidate there that kind of speaks to this as opposed to clash with it, I'm beginning to wonder if this entire thing is irrelevant, because what this election really is a referendum on Donald Trump.
No, because it isn't. In the mind of one party, it is, but I think for many people in the United States, it's not. And I think maybe so. The thing that's frustrating for me, and I don't know if it is for anybody else, and I was having some conversation with friends, like a big group chat, and friends, and the question is are they going to replace him, and who do you think they are going to replace him with? Mm-hmm. And the most frustrating thing for me, Ilya, is that we are having a conversation and we've completely removed ourselves from having the opportunity to participate in that discussion. We are the they. Or if you're a member of the Democratic Party.
Already occurred. It just wasn't
the point is, Ilya, is that the Democratic Party had the opportunity to run these primaries and run them correctly, or at least have somebody challenge him outside of Dean Phillips, like to make the case that party had no idea that the American voter had these types of concerns. It's ridiculous. It's completely ridiculous.
That's not anything I'm saying.
I know. I'm just saying the frustrating part is to get here, and then we're having this discussion about some, men above the clouds that get to make this choice when I feel like this is such a pivotal moment for America to not have a voice in the selection process. Nobody's talking about that part, and I think that's a very important aspect of this. And and if they are talking about it, they're saying it through the lens of the American voter has already made their choice. No, they didn't. You didn't run an effective primary. You didn't challenge him with anybody who could have actually beat him.
It wasn't.
You didn't put him on the ballot in Wisconsin. You tried not to. You didn't put him on the ballot in North Carolina. You canceled your primary in Florida. So it's either you didn't really run it, and you had these concerns, and you tried to just kind of shuffle them by the American voter, or you did run it and you kind of I don't want to say gerrymandered it, but jerry-rigged it.
Let me ask you this.
Sure.
Do you think that anybody that voted against a second Donald Trump term in 2020 is going to say, you know what, I didn't like the way the Democrats ran the Biden primary. I'm going to vote for the other side.
In droves. It's happening.
So I think that
I'm one of them. I'm
almost certainly not going to happen.
It is. I'm telling you right now.
In any kind of a consequential number at all.
It's happening in the African-American community. It's happening in the working class community, and everybody that's negatively impacted by inflation. I think you'd be really surprised at how many people are going to there's a reason why I think the
swing voter in this election is almost non-existent.
I agree. But I think people have made up their minds. I think there's a reason why it's 69% right now, man. It's not at the beginning. This narrative made sense to me when it was 50-50 or 55-45. I think in general, people have made up their minds, and I think there are a lot of more people that have made a switch in their thinking from 2020 to 2024 than you think
to be the case. I think maybe it's possible, of course, right?
Then why are we having this conversation on switching the candidate? If you think he's got the electorate support, then why do you think we're having this conversation to begin with?
Because I think that people, first of all, I mean, so there is the classic explanation, which is that in the Democratic Party, because you have a more fractured coalition inherently, a more diverse party with more divergent interests, where infighting is common, that
I agree with that.
That this is just the nature of the beast for them. They don't come together and unify as readily. We just saw, for example, at the RNC, all the people that were barking with aggressive vigor in Donald Trump's direction mere weeks ago have all said, you know what? That's it. This is the convention. We're going to unify behind the candidate. That's it. Done. That kind of a thing is more difficult historically on the other side. So one explanation is that this is the usual kind of thing that Democrats do.
Yeah, and that's always the thing, that Democrats are going to ribble-rabble or rabble-rouse, whatever. They're going to complain, but at the end of the day, they're going to show up. They're going to punch the ticket the way that they always do. But I'm telling you, that is not going to happen this time around. Like there's groups of people who the Democrats have always been able to rely on, and I think you can push groups of people only so far. And I think the Democratic Party is going to find out that there are a couple groups. And I think if that wasn't the case, my friend, this would not be a 50-42% discussion between Biden and Harris.
I don't put much stock in these polls.
If you could buy one thing on the board, what would you buy on this screen? You can buy one thing. What are you buying?
I mean, if I looked at this right here, I'd say that the 50-50 shot for the Biden-Harris realignment, that's possible.
You would buy
Biden? That's
not
unreasonable to me.
You say you would buy Biden at 50 cents here.
Yeah.
50%.
Yeah. But I think the pricing is fair.
Yeah.
I think that's about right. Like, I would not be terribly shocked if all of this set up a Biden exit and a kind of handing of the torch. I'm sort of reminded of the moment where Reagan admitted the Iran-Contra affair and comes on and says, I know I told you a couple months back that this was definitely not a thing, and in my heart, I feel like it's still not a thing. But the facts seem to suggest that it's a thing. And so I sort of get this sense that maybe you get a Biden, if he is coerced with enough vigor, that comes out and says, look, I still think I got it. I still think I'm the best candidate today, but the most important thing now is unity, and we need to rally against something that brings this whole thing together because we have an election to win.
Amen. All right.
It's possible.
I am long, and producer's gonna be pissed off. Just let you guys. I promise you. I don't know. I'm in town, so I'll get you guys something special on Monday when I come in there. I promise you. There's two more things I wanted to cover with you real quick, and Ilya, I'm going to ask you to be super short with your answers, but I've got to ask you. I was too animated, emotive just now, but thank you for fielding that and bouncing it back off me in a professional manner. You're a gentleman and a scholar as always. Jamie Dimon, Treasury Secretary, Donald Trump. What do you think about that potential?
I don't know that it necessarily matters one way or another. I think we've seen what happens when kind of mainstream finance people go work there. It hasn't worked. Gary Cohn obviously is a Jamie Dimon kind of guy, sort of in the grand scheme of things. And we'll see. I mean, the lesson from the last Trump administration is not to get married to any one cabinet minister because the churn is quick. So we'll see. Steve Mnuchin, I would say, was relatively effective and was one of the ones that lasted the longest. I would not be surprised if he came back in some capacity, but if it were somebody outside of kind of the usual and more closer to the traditional of the finance universe, like a Jamie Dimon, I wouldn't be surprised if he comes, the churn is fast.
Yeah, it's a smart move politically, if nothing else. Let me ask you. So the last thing we're going to end on, and I didn't tell you I was going to ask you this question. I don't tell you anything really, but that's how genius you are. This is totally you're totally answering all these questions. Exactly. During the RNC, President Biden announces a few new actions to lower housing costs. I'm reading from the White House press brief. Announces new major actions to lower housing costs by limiting rent increases and building more homes. The building more homes is about 15,000 more affordable homes in Nevada, and the basically the rental cap of 5%. What do you think about that?
I am completely out of consensus on things like this with the U.S. median voter. The U.S. median voter has gone further in the direction of industrial policy, further in the direction of deglobalization, further in the direction of government involvement in economic outcomes. And that has been bipartisan. And I disagree with it on both sides. I am always suspect of this kind of an attempted short-circuiting of the price discovery process and of price controls and of attempting to bend market forces to some sort of a directive. That never comes without unintended consequences, and those unintended consequences tend to be worse than the benefits to be had from the policy. Now, the building of things is a good thing, I would think, generally.
More supply, good.
More supply is desperately needed all across the U.S., if only because the housing inventory is about 4-to-1 existing to new homes. Is it any wonder that the price is stuck where it is? So if you look at what's happening on that side of it, yes, more building, good. Price controls, we'll see if they work politically. We'll see if it's a salient message for voters. I'm not a fan as a policy trajectory. That doesn't mean that I see some sort of a market tradable outcome out of this. I don't necessarily connect this kind of an announcement with this or that thing that I'm buying or selling. I just think from my personal perspective on how good economic policy setting works, this is not it. And also, I am out of consensus with the median U.S. voter on that assessment. The median U.S. voter is not a laissez-faire internationalist.
Yeah. I think I'm actually in your camp, and it's hard to articulate that, I think, sometimes, because maybe you seem as somebody who's like has less empathy, or because there are a lot of people in America who need help. And It's hard to say that the proposals for help may actually be bad medicine and make you more sick. And that's, I think, in essence, what you're saying. That be careful of the doctor's prescription.
When you start with the price,
that's right,
and not with the incentives that guide the price as the beacon for policy, you oftentimes end up doing more harm than good. When what you're saying is the price can't adjust no matter what's going on in the economy, because we've put these guardrails on it, what's going to happen is the economy will kick out an offsetting outcome that you're not going to like someplace else because the price can't clear over here. It'll clear someplace else. As Jurassic Park teaches us, nature finds a way.
Nature finds a way. All right, we got the chat. I knew this was going to happen, and I purposely saved these questions to the end. Thank you to the production team for humouring us for an extra couple minutes. Thank you to all of you. Do me a favor, hit the like button before we get out of here if you enjoyed the conversation. Even if if we said some contentious things, the goal of this show is maybe to say some stuff every once in a while or have some conversation that maybe you shouldn't. Ilya, thank you, as always, for joining us as you do every single Wednesday. Tell the people if they want to hear more from you this week where they can go and hear from you on Tasty.
Always a pleasure. I am here all week as usual. I'll be out next week for some holiday, but generally I'm here with Overtime Monday through Thursday, show where Dylan, Chris, and I look at the Wall Street close and why it did what it did and what might happen next. That's followed immediately by Macro Money, a show that I do delving into the nerdy side of things with lots and lots of charts and lots of depth. And obviously I'm here every Wednesday. You and I are on with Tom every Sunday for First Call. I'm on with Chris for Futures Power Hour Fridays. I'm writing for the News and Insights portion of tastylive.com. And I'm tweeting, because that's what I'm still calling it, at Ilya Spivak.
You are one of the hardest working men in show business. If you want to find the tweets of a madman, or you want to follow the tweets of a delusional madman, you can find me at Victor Jones, the Owen Jones of the zero, because I like to be difficult. Thanks again, Ilya. You're a gentleman and a scholar, and it's always fun having these conversations. If you don't believe me, I call Ilya, I don't know, maybe once a month. We'll have a 3-hour Sunday conversation. He'll humor me on a lot of these topics. And for this time, we got the chance to do it in public. Ilya, thank you very much for sharing your wisdom and knowledge with us, as well as your patience. Thank you to all of you for watching. We'll see you back here tomorrow, same time, same place, same great network, only on Tasty Live. Peace.
Peace.